Welcome to Wealthion. I'm Wealthion founder Adam Taggart. I've been a big supporter of the Hard Assets Alliance for a long time, for over a decade. In fact, a company I co-founded was one of the founding member firms that participated in launching HAA. And now, I'm pleased to have the chance to share this video of my interview with James Rickards with you. It was recorded earlier this year for Wealthion's investor conference, which was a private event. And even though that was before the outbreak of war in Ukraine, Jim's material here is more relevant now than when this was first released. It's almost prophetic. As Hard Assets Alliance supporters, you're the first ones I'm making this video available to since our private conference. And I hope you find this discussion with Jim as valuable to your 2022 investing plans as it has been to mine. All right, though, enough talk. Let's get straight to the interview. Well, folks, when trying to ascertain where things are headed, the best strategy is often to talk to the person sitting at the center of the information flow. Few sit closer than James Rickards, editor of the Strategic Intelligence newsletter, advisor to the Department of Defense and U.S. Intelligence Services, and the author of numerous New York Times best-selling books, including The Death of Money, Currency Wars, and the new Great Depression, Winners and Losers in a Post-Pandemic World, which is very topical to our theme for this conference. Jim, thanks so much for joining us today.
Thank you, Adam. It's great to be with you.
All right, so let's start at a high level here. So you've been chronicling, I guess what I'll refer to as the decline of prosperity in the U.S. and other major world countries for decades now. At a high level, where are we in the story right now? What most has your attention as we're entering here into 2022, and what do you think is going to drive the action from here?
Well, Adam, I do a lot of analysis and recommendations and predictions, et cetera. I have a company that specializes in predictive analytics, kind of cutting edge technology using artificial intelligence. And when you're in the prediction game, you win some, you lose some. You try to win a lot more than you lose, obviously, but no one bats 1,000. But I had one prediction recently, which has turned out to be just perfect. And I wake up every day and it's true. And it was somebody asked me last summer during the kind of the height of the Afghanistan thing, but of course, COVID was still going on. Other problems were emerging, et cetera. And someone said, Jim, what do you think is going to happen? I said, it's going to get worse. And so far that prediction has been 100% accurate because things are getting worse. So I'm going to stick to that. But the thing that I'm most focused on at the moment, of course, I've spent decades, looking at Federal Reserve policy, monetary policy, inflation, the risk of deflation. We haven't had real deflation, but we get uncomfortably close from time to time. The other D word that people don't that deserves more attention, in my view, is disinflation. Disinflation is not deflation. Inflation is when prices go up. Deflation is when prices go down. Okay. Disinflation is still inflation, but it means that prices are going up at a slower rate. So, and it's a big deal. So if the latest inflation numbers, we're looking at 7% CPI year over year. That's the hottest inflation since 1982. I was around. I was working in the banking industry in 1982. I remember that very well. But if it goes from 7 to 5 to 3 to 2, it's still inflation. 2% is still inflation. We cut the value of the dollar in half in 35 years, but it's down a lot, and that's disinflation. I think that's what we're going to see. So I spent a lot of time on that. But the more and I'm enough of a geek. I read the FOMC minutes and I read speeches by Jay Powell and some of the other governors and vice chairs and all that. But it's become apparent, has been for a while, but now it's beyond doubt that the Fed is irrelevant. It's impotent. You can get all spun up and you go on CNBC and talk about the Fed, and people do, but it just doesn't matter. And your Austrians and your monetarists and, your hard shell, Friedrich Hayek people they look at the Fed money printing, and it has gone from, well, if you go back to 2008, the Fed balance sheet was 800 billion. by 2013 or 2014 at the end of the first taper, it was 4 trillion. Then during COVID, it got up to 7 trillion, maybe higher. People say money printing, here comes the inflation. Here comes the inflation. That money printing is not what caused the inflation. There is inflation, there's no doubt about it. But the Fed creates money, base money. M0 is the particular definition for the money they create. And they do it by buying bonds and notes from the banks. They call Goldman Sachs and say, offer me some 10-year notes. And they say, here's the price. The Fed's is done. And Goldman sends them the 10-year notes. And the Fed pays Goldman with money that comes out of thin air. They just credit their account and there it is. But then Goldman, and I shouldn't pick on Goldman, this is true of Citi, Morgan Stanley, and Bank of America, and all the rest. They take the money, like, what do they do with the money? They give it back to the Fed as a deposit in their account at the Fed in the form of what are called excess reserves. Okay, so the Fed created money by paying the banks for the bonds, and then the banks took the money and gave it back to the Fed as excess reserves. What did that money do for the real economy? Nothing. No loans, no investments, no credit, no nothing.
No velocity.
No velocity. Well, you're right. That's a separate issue that has to do with consumer behavior and psychology. But but you're right. No, at least technically, no velocity came out of it. So that doesn't matter. You could take it to 15 trillion, I guess, and kind of nobody cares. That's not what drives inflation. Maybe we talk about what does, if you like. But so I still read all that stuff, but I honestly don't care that much about the Fed. I don't think it matters who's on the board. I don't think it matters what they do. They're relevant and impotent. They're putting on a good show. You know, Jay Powell's been up on the Hill recently testifying in connection with his confirmation hearing. And, you know, CNBC still gets all spun up every time there's the minutes are released or whatever, but it just doesn't matter. What does matter, and what I'm looking on, is the breakdown in the global supply chain. That's real. It hits the consumer right between the eyes, like what I just talked about. You know, how does the Fed create money and what do they do with it? And the banks give excess reserves. Yeah, that's enough to put most people to sleep. But supply chain is real. You go to the store, and maybe a store you've been going to for 20 years, and the shelves are bare. And most people's first encounter with this was early in the pandemic. So I'm talking about the spring of 2020, March, April, May 2020. The story was, I went to Costco and the paper goods aisle was cleaned out, toilet paper, paper towel, that was cleaned out. And it was. But that was not exactly a breakdown in supply chain. There was a lot of hoarding. People just thought they needed a lot of toilet paper. Who knows? Maybe nobody was ever going to be allowed outside again. So that was hoarding, and it's understandable. But the rest of the aisles were pretty full, and your supermarket was full. That's not true today. You don't have to go to Costco. You go to a supermarket, and there are bare shelves everywhere. And I'm not saying every shelf and every aisle is bare, but when was the last time you saw any bare spots outside of like East Germany during the Cold War, or maybe a third world country? And the answer is you haven't. So, but we're seeing it now. So what's interesting about that kind of politically and psychologically is, as an analyst, I can look into it, and I have, and look at the causes of it and why it's not going away, by the way, why this is going to persist. But it's not just an academic or analytical exercise. It's real, and people see it, and they're a little bit shocked. And the response function is interesting, and I'm no different. I'm a consumer. I talk about this stuff. Sometimes I say that inflation is not, not sometimes, I do take the view that inflation is going to fade, and it's not as big a problem as a lot of people think. But I put gas in my car. I pay New Hampshire, where I live, it's a little over $4 a gallon for premium, but I think New Hampshire is kind of low. I think in California it's well over $5, and maybe on its way to $6 in some places. So
yeah, you guys are the junior varsity out there when it comes to gas prices.
I think that's real. I think that's right. But it's still $70 to fill up my tank, as the case may be. So I'm not immune from that, and I see it. But the supply chain thing is real, and it's not going away. And I think it's going to become more of a political issue. I try not to politicize things. I just want to understand them. But it's the politicization of it is going to be unavoidable as we get closer to the midterm elections.
All right. So a couple great threads to pull on there. Let's start first with the inflation one. So you say, okay, look, the Fed's not really inflationary. It's stimulus doesn't really go into the real economy that much. Global supply chain breakdowns do have an inflationary effect. You just described how. I guess two questions for you. So one thing you didn't talk about on the inflationary side is fiscal stimulus. And in the US to date, it's been around 10 trillion or so of both monetary and fiscal stimulus, but about 5.5 trillion of that, by my numbers, is fiscal. And fiscal does tend to be more inflationary, I believe, because it gets directly out, to real into the economy, payments directly to people, et cetera. It does contribute to velocity. So curious on your thoughts on the role of fiscal stimulus that's had on inflation, and whether that's something you think is going to abate or continue. And then just address on the supply chain side of things, totally agree with you, but somebody might say, yeah, but that's all fixable, right? You just, capitalism is going to respond, people are going to overinvest to try to make up for those shortages, et cetera. Why are you concerned that it's going to be more persistent?
Well, let's take this one at a time. There is no fiscal stimulus at this point. Now, there is huge deficit spending, no question about it. I remember the first time the U.S. had a $1 trillion deficit for 1 year during the Obama administration. I was like, wow, people had to actually retrain their phonics so they could say trillion instead of billion. But and that persisted for a couple of years in 2009 and 2010 in the aftermath of the 2008 global financial crisis. But to their credit, the Obama administration did kind of wrestle that back to the ground later in their administration. And by 2013, 2014, at the end of the Obama administration, they had got that back down to around 500 billion. Still a big number, no doubt about it. But the $1 trillion thing came and went. Then Trump comes in, and toward the end of the Trump administration, you're back all of a sudden. Here comes the $1 trillion deficit again, not in the first year, but by 2017, 2018. So we were looking at $1 trillion, what's called baseline deficit. Baseline means if you don't do anything new, no new programs, nothing, you just keep doing everything the way you're doing, it's going to be $1 trillion deficit. So that's your baseline deficit. So we went into the pandemic with that. So then Trump pushes through a approximately $1.9 trillion COVID relief bill around May, June 2020. And that's when everyone got your first $1,400 check. And then pushed through another almost $1 trillion, about $900 billion in December 2020, just before he left office. And that was your $600 check. Well, Biden comes in, not to be outdone. And in February 2021, right at the beginning of the administration, they put through another $1.9 trillion. And that was $1,600 checks. Everyone did get these checks. I mean, you're right about that, Alan. And then the $1.9 trillion infrastructure bill. And now there's another, so I think it was about 1.2 trillion infrastructure. And now we're looking at another maybe 1.9 Build Back Better. That may not pass, but we can leave that. Okay, so you had $1 trillion baseline deficits for 2020, 2021. And then you threw, let's see, 2, 3, 4, 5, 6, almost $7 trillion on top of that. So that's $9 trillion counting the baseline. And where is U.S. debt today? It's up to $30 trillion. And the gauge I look at, you really can't judge by the absolute level of the debt. It's like, okay, it's a big number, but if the economy is big enough, you can support more debt. That's not necessarily a horrible thing, depending on how big the economy is. So the ratio I look at, and a lot of economists look at, is debt to GDP. How much debt do you have divided by the GDP? Because the GDP is like your ability to pay the debt or to refinance the debt. And the analogy I use is if you make $50,000 a year and you've got $60,000 on your credit cards accruing at 25%, you're probably going broke. But if you make $500,000 a year and you've got $60,000 on your credit card, you can probably pay it off with a check. And so you can't focus on the $60,000. You have to look at the income that's supporting it. Well, the same thing with the country. Although my friend Stephanie Kelton, a modern monetary theorist, would not agree with that last statement, but I'll stick to that. It does matter. So what's the GDP? Well, it's around 23 trillion. Now, before all this started, up to 2020, The debt was slightly higher than the GDP. It was around 105%. It was kind of like 23 trillion to 22 trillion, more or less. But all of a sudden, it's 30 trillion to 23 trillion. That ratio is 130%. Well, who's at that lunch table? Greece, Lebanon, and Italy. They're the only other country. Japan's a separate case. Japan is worse. I'll grant that, but put Japan in a separate bucket. But Greece, Italy, and Lebanon are the only other countries that have a debt to GDP ratio as high as the US. Now, what does that mean?
Yeah, not the 18.
Exactly. Now, what does that mean in terms of stimulus? Because that was your question. Well, it is true. It is true that when the checks went out, the $1,400 checks or whatever, there was a bump in retail sales. I mean, you can look at it, just look at retail sales, year over year, month over month. It spiked in like the month following the month when the checks went out, but then it went back down again. In other words, did people to some extent get the checks and go buy stuff? Yeah. But did they do it the next month? No, because there wasn't another check. So it was, I don't know, I hate cliches, but people call it a sugar high or whatever. I mean, that's kind of what it was. But it kind of goes to the last part of your question, Adam, which was, is that sustainable? And well, if you want to do another $1 trillion handout every month from now on, maybe, but although I think people will get wise to that pretty quickly, but they're not doing that. In fact, it looks like the Build Back Better bill is dead. It's just not happening. And every day that they're not even debating it in the Senate anymore. And every day that goes by, you get one day closer to the midterms and nobody wants to vote on this thing, 2 months before the midterm or even the primaries for that matter. The spring is the real drop dead date on that. So it looks like that's not happening. No more handouts, no more checks. You still have the baseline budget deficit and you still have some of the spending from the prior bills. But no, we're not getting any more checks and we're not getting any more candy handed out. And the Fed's tightening. That's a whole other debate. They say, well, they're just tapering at this point. They're not raising rates probably till later this year. Well, I'm sorry, tapering is tightening. People say, well, they're still printing money. Yeah, but they're printing less money than they did the month before each and every month. And in economics, things happen at the margin. You don't have to look at the absolute level or even the plus minus sign. Sometimes you have to look at the marginal impact. Marginal impact is less money printing. It's going to get to zero very soon by March. And then we'll look at some rate hikes after that. That's a pretty serious form of tightening. So if the Fed's tightening monetary policy and the Congress is tightening fiscal policy because they just said there are no more handouts, and the economy is weak, which it is because of the supply chain thing, supply chain breakdown, which we just talked about. I mean, that's like recession talk. I'm not predicting a recession, but that is sort of what you might be headed for with that policy mix.
All right, so I'm going to go back to your disinflation from earlier. So if correct me if I'm wrong, but I think you said that's sort of what you expect to be maybe the dominant theme, at least in the near term here.
Right.
So let's use the analogy of a ball that's been tossed up in the air, right? So you throw it with a bunch of force, right? So it's rising very quickly. We'll call that inflation. But as it begins to approach its apex, its rate of climb declines, right, until it's hit the apex, right? So that second part of the first arc is the disinflationary part, right?
Right.
So there's that apex where all of a sudden, things aren't increasing anymore, and then you begin to head over, and economically we would call that deflation. So you just made a really good argument where, okay, economic growth is slowing. All those trillions of stimulus, both fiscal and monetary, those spigots are turning off.
Right.
Interest rates are now going to go up. We haven't mentioned the topic of a market correction yet, but those could be triggers for a market correction. And you don't need a market correction necessarily to go into a recession, but it doesn't hurt, right? So what do you think are the odds of us, hitting an apex and beginning to go down the deflation route?
Well, you have to do disinflation before you get to deflation. So I'm not ruling out deflation. I think that's a serious concern. But
that's my question: is disinflation a path to deflation here in your probability?
It can be if you are on a strong disinflationary path, and then you actually go into a recession, you could be looking at deflation. So that is not something I would rule out. I have a longstanding intermediate term forecast for the price of gold at between $10,000 and $15,000 an ounce. We don't have to talk about that now. I've spoken about that quite often, but I do remind people. I say, well, you got to get to 3,000 before you get to 10. In other words, if you're doubtful about the 10, I'm happy to explain it, but it's going to hit 3 or 5 before it gets to 10. So, and the same thing is true about deflation. You have to disinflation first. Now, here's the point. Between 2008 and 2014, the Fed took the balance sheet from 800 billion to 4 trillion. We already spoke about that. What was inflation during the entire expansion? The expansion started in June 2009. The National Bureau of Economic Research said recession was over June 2009, new expansion. It was the longest expansion in U.S. history, and it ended in the first quarter of 2020. So just say bracket 2009 to 2019, the 10-year plus expansion. What was the average annual growth rate during that expansion? It was 2.2%, 2.2. What's the average annual growth rate of all expansions since 1980? The answer is 3.2. What's the average annual growth rate of all expansions since the end of World War II? That number is about 4.3. In other words, this is why I keep using the phrase depression. People go, where's the depression? Recession is very well defined. It's 2 or more consecutive quarters of declining GDP and a few other bells and whistles. That's a recession. The National Bureau of Economic Research calls the Boston strikes. Economists love it because it's quantifiable. You can stick in a closed form equation. Everybody gets that. Nobody in economics likes to use the D word, the depression. Why? Because first of all, it's depressing. Everyone wants to talk about that. And secondly, because it's not quantitatively defined. It has a lot of, it's much more subjective. But the point about depression, people say, well, if a recession is 2 quarters of declining growth and a depression is worse, well, depression must be 10 quarters of declining growth, and we haven't had that. But that's not the definition of a depression. Depression means depressed growth relative to trend, meaning you can still have growth in a depression. In fact, we had pretty good growth in 1933, 1934, 1935, and the stock market rallied in the middle of the Great Depression. But the point is, it's growth below trend, below potential, and you never get back to where you were. So if the potential of the U.S. economy is 3.2%, which is the post-1980 number, or 4.3 approximately, which is the post-World War II number, and you're growing at 2.2, that is depressed growth, and that is the definition of a depression. And people go, wow, Jim, it's only 1%, like 3.2, 2.2, who cares? Sorry, that's 1 full percentage point of the entire U.S. economy. You take 1% of 22 trillion and compound it over 10 years, you're talking 4 or 5 trillion of lost wealth. It's a gap. Here's the 3.2 and here's the 2.2, and that gap, because it's a wedge, it keeps getting bigger. It keeps getting bigger over time. So we've left trillions of dollars of wealth creation and higher income and real wages on the table because of depressed growth, what I call depression. And why is that? Analytically, what's causing that? Well, what's causing it goes back to what we said earlier, the debt to GDP ratio. There's a huge body of research. Carmen Reinhart and Ken Rogoff of Harvard. Carmen Reinhart's at the World Bank now, but she was at Harvard before the University of Maryland. They've done some pathbreaking work on this, but so have a lot of others, including staff economists at the Fed. So there's just a lot of research that says that you can have a mild Keynesian multiplier up to around the 90% debt to GDP level. So if you're, where were we in 1980 when Carter handed off to Reagan? Well, the debt to GDP was about 30%. Well, that's prime Keynesian multiplier territory. You pile on more debt, you borrow $1, you spend $1, you might get $1.50 of GDP. There are other debates about whether you just bring it forward and it's sustainable and all that, but that is empirically correct. But as the debt goes up and up and up, and as the debt to GDP ratio goes up and up and up, the multiplier gets smaller and smaller. So all of a sudden, this goes to your point, Adam, about the parabola of the ball. I think of it as kind of coming off the bat. Somebody hits the ball, Willie Mays is in center field, and he's like, "Where's it going?" But you watch it go up and then watch it come down. What happens is as you get over 60%, and that's the limit in the Maastricht Treaty, and that's what Angela Merkel was always harping on. it gets closer to one. You borrow a dollar, spend a dollar, you get maybe a buck or a dollar five. But past 90%, you borrow a dollar, you spend a dollar, you get 90 cents. You don't even get your dollar back in terms of growth. Then 80, then 70, then 50. In other words, you're now on the downslope of the curve. You are borrowing more money, but you're not getting any net growth relative to what you borrowed. And it's basically, so the Keynesian multiplier goes negative, it goes below one. And more to the point, if you're borrowing money and not, if you're borrowing a dollar and not even getting a dollar of GDP, what's happening to the ratio? It's going up. It goes 130, 135, again, join Lebanon at the lunch table. And so that's why there is no fiscal stimulus. And that's why we're burying ourselves. And that's why we're not, the old saying is true. You cannot borrow your way out of a debt crisis. If debt is your problem, and that's why you're not getting growth, you can't borrow your way out. How can you get out? What are the ways out? Well, one is default. That's the Argentina routine. But there's no reason for the US to do that. We print the money that we owe. If you owe dollars and you print pesos, that's tough. But if you owe dollars and you print dollars, okay, print them up. Hey, China, here's your $1 trillion back. Good luck buying a loaf of bread, but here's your trillion. So that's one way out. The other way is higher taxes, but that tends to defeat the purpose because you throw the economy into a severe recession. That's super austerity. But the American way, the right way, is inflation. You basically steal it from everybody through inflation. So you still have this debt. The 30 trillion in my example doesn't go away, but the real value of it can be cut in half if you cut the value of the dollar in half. And how do you do that? Well, it's not that hard. We've done it before, but the patient way is 3% inflation for 15 years or 14 years will do it. Cut the value of the dollar in half. But how about 5% inflation for what would it be 14 years? That does it too. It's just divide inflation into 70, and that tells you how many years it takes to cut the value of the dollar in half. So 5% inflation for 14 years would cut the value of the dollar in half. So 30 trillion in real terms would be 15 trillion in my example, real money. And that's how you get out of it. Here's the problem. So I just told you the answer, which is inflate your way out. By the way, does wonders for the price of gold, et cetera. But it's a sad day when a central bank wants inflation and can't get it. And that's the situation we're in. Now, I know inflation's hot right now. GDP is too high and there's no more handouts, and the economy's slowing. So that's going to bring inflation back down to that level I described, around 2.2%. Not overnight, it's going to take 6 months, but I would say, yeah, inflation has peaked. It's going to come down, not all at once, and it's going to get into that rut of around 2.2%, give or take. That's the growth rate. The inflation rate during that same period was more like 1.8. Sorry, I was mixing inflation and the growth. The growth was 2.2, but inflation from 2009 to 2019, the Fed's target was 2%. They only hit it once or twice. There were only a couple of months where they hit 2%, and then it went back down again. But often it was 1.6, 1.7, talking about core PCE, because that's what the Fed looks at. So I expect it to get back down to that level. So there's no stimulus in monetary policy because of velocity. There's no stimulus in fiscal policy because the debt to GDP ratio is too high. COVID's still around, supply chain's getting worse, and the economy's going to slow.
Okay, so so much in there, and Jim, I'm wishing we had like 2 hours here to get through all this. But it seems like for all the reasons you just mentioned, you see, I'm going to say disinflation, deflation kind of being the trend that sort of wins in the long run here as we kind of grind through this new depression. You haven't put a time range on it yet, but kind of the way you're talking about it, it just sort of seems like it's going to be as far as the eye can see. It doesn't seem like there's a point in this trajectory here where we return to the greatness in the high growth economic growth that we used to have. But if you feel differently, let me know. Now getting to, I think, the question on most viewers' minds here, which is, okay, so Jim sees a world where we're kind of entering into this slog of anemic economic growth, increasingly weighted down by our debts. We've got a lot of of interconnectivity that's so complex we can't even understand it. But there's just lots of hidden risk factors in there that we're going to be stumbling into. As an investor sort of looking towards this future, where are the areas that you think make sense for people who are trying to figure out how to allocate, their portfolios for this type of future? Where do you see the greatest, where do you think a sane portfolio allocation might look like in this world?
Well, I just be clear, Adam, I do not give individual investment advice, and
Absolutely.
any listeners who happen to be clients or individual investors, talk to your registered investment advisor or your broker or your brother-in-law. But I don't speak to that issue at any individual level. However, I can and I do speak at a macro level, and based on the kinds of things we're talking about, which are growth projections and fiscal policy, monetary policy, et cetera. And in the world that I've described, in that macro world, I would say if you knew inflation was coming, you would know exactly what to do. You'd buy some gold and buy some real estate or whatever. If you knew deflation or disinflation was coming, you would know exactly what to do. You'd buy 10-year notes or 5-year treasury notes, and you have more cash because the real value of cash goes up, and deflation could be your best performing asset, et cetera. The difficulty, of course, is that we don't know exactly what's coming. I mean, I gave a disinflationary scenario with some deflationary potential. That's my view. I wouldn't say it if I didn't think that's what was coming, but there's a lot to be said for the inflationary view. I mean, I study it. I don't ignore it, and I don't think it's coming, but I can't rule that out. So what do you do? Well, the answer is you need to be, first of all, you need to be nimble. The whole set it and forget it thing, that's what Wall Street sells you. That's about the worst thing you could do. The idea that, okay, here's my model portfolio, I'm going to put it on and I'm going to take a 3-year vacation, come back and say how I did. That's a huge mistake, because you almost have to wake up every day or periodically and just say, what changed? Is this playing out as expected? Is there a good entry point here? Those are the kinds of questions you have to ask yourself. But
yeah, and if I can just flag real quick, sorry to interrupt you, but that strategy has worked for a long time. So it's going to require some reprogramming of the average investor, correct?
Well, I agree completely. And in my book, Aftermath, I think it was chapter 3, I talked about passive investing versus active investing. And the mantra, this goes back to Jack Bogle in the 1970s, and with the invention of the index fund. And the notion was, hey, you can't beat the market. You just can't. People say you can't, but you really can't. But the market tends to go up over time, which is true. And what you really need are low cost. So buy an index fund and just enjoy life. And the fees will be really low because we don't have all these research departments and all this stuff. And the market goes up. You'll have big dips, but hang in there. Don't sell the dip. Just hang in there and it'll go up. Well, the problem with that, and that has worked, by the way, it's undeniable. But the problem with that is the passive investor is a kind of parasite on the world of active investors. Speculators, price discovery, researchers, people who do what I do, predictive analytics, et cetera. These people are working hard to figure things out, and they do, some better than others. But yeah, that's a real thing. You can forecast the future. People say you can't. You actually can, because the future is here today. You just have to know where to look in terms of what's called path dependence. But but the passive people kind of piggyback on the active people, and they're like a parasite, sucking blood out of the host. The problem is, so much money has gone from active to passive that now the passive is it's up around 70% of all the assets in the stock market. The active crowd is getting smaller and smaller. You're going to kill the host. And what I mean by that is, what happens when there's a real correction? When I say correction, I'm not talking about 10%. I'm talking about something like what happened in 1929, and we've had many other examples of it. Well, an index fund has to follow the index. So if stocks are going down, they're going to get redemptions. So they have to sell stocks and get cash and pay the redemptions. Well, it's the opposite of what's been going on so far. What's been going on so far is, I have a portfolio, money comes in, I buy the index. More money comes in, I buy the index. More money comes in, I buy the index. What's happening to the index? It's going up. What does that mean? More money comes in. Now, it's a recursive function. It's a feedback loop that feeds on itself, and that's how you get bubbles, and that's exactly where we are. Well, it works in reverse too, except it works a lot faster and a lot, the idea that I see the top is starting to go down, plenty of time to get up. No, it'll drop like a stone when it happens. But in that world, the stocks go down. People go, huh, now I'm afraid. Call your broker, get a withdrawal. What does the fund manager do? Well, they have to sell stocks to give you the cash. What does that do? It drives the price down, more redemptions, et cetera. So this the same recursive function works in reverse, but it works a lot faster. And so where's the active crowd who are like, doing price discovery and making two-way markets and buying the dips? They're gone. They've been, I have a very good friend who was a director of operations on the floor of the New York Stock Exchange. He's one of the guys who, wears the blue jacket and goes down there to the trading post and all that. And he said, he's a good guy. He said, Jim, don't ever let anyone tell you there's any liquidity on this floor. There is no liquidity on this floor. First of all, 95% of the trades are automated. They're all computer systems. Only about 5% gets done face to face. Number one. Number two, I've been in the New York Stock Exchange, very tight security, by the way, these days. But it's kind of it's a museum and a TV set. I mean, I think I respect the people who were down there. It's got a great legacy. It's an interesting place, but it's not the market. Those guys aren't going to, the good guys, but they're not going to save you. And so investors have to be prepared for that kind of new reality. First question you ask yourself, are we in a bubble? The answer is absolutely yes. Everyone says, well, you can't spot a bubble. Like, yes, you can. It's the easiest thing in the world to spot. What you cannot do is predict when it will break. That's hard. When it will break is bubbles can go on longer than you think. Bubbles can go on longer than you can stay liquid if you short the market. I certainly don't want to short the stock market because you could lose a lot of money being right. But so it's very hard to predict when they'll break, but it's very easy to see that they're bubbles. And so what you need to do is fade it a little bit. I would have more cash than usual. I would be stepping out of the stock market. I always recommend 10% gold. People go, well, Jim, you're very bullish on gold. Why not 50%? Well, you don't want to be that high in anything. It doesn't matter what your thesis is. It doesn't matter what your analysis is. You don't want to be that concentrated in anything. 10% gold is just fine. If I'm wrong, and obviously I don't think I'm wrong, or I wouldn't say it, but if I'm wrong, you're not going to get hurt. If I'm right, you're going to make so much money that 10% is fine. And so, a 10% slice in gold, I would say 30% slice in cash. And people go, oh, cash is horrible. There's no yield. You don't get any return and all that stuff. Well, a couple of things. Number one, in deflation, which you can't rule out, cash can be your best performing asset because the real value actually goes up. Number two, it's the opposite of leverage. This is a little bit of portfolio theory, but cash reduces the volatility of a total portfolio. So if you have volatile assets, and gold is volatile, stocks are volatile, some alternatives are volatile. You've got assets that are kind of jumping all over the place. If you have a slice of cash in the middle, it'll reduce the overall volatility, so you can sleep a little bit better at night.
Ballast.
Yeah, exactly. And it's the opposite. Leverage will take volatility and make it more volatile. Cash does the opposite. But here's the most important value of cash. And people don't understand this. It has embedded optionality. If you're the person with cash, that's the equivalent of, if I said to you, Adam, I'm going to sell you an at-the-money call option on every asset class in the world. You'll go, that sounds kind of interesting, But that's what cash is. If you're the one with cash, you can go out and buy any asset class on no notice at the market. So when this crash comes, which I am expecting, or other bad things happen, or other asset classes, collapse, you can go in the wreckage and pick up some really cheap stocks. And by the way, nobody is better at this than Warren Buffett. Warren Buffett, you go look at the balance sheet of Berkshire Hathaway. It's public information. Their cash position is at an all-time high. It keeps going up. I think last time I looked, it was something like $150 billion. I'm sure it's higher today. But what does Warren Buffett know that the rest of us don't know if he's so large in cash? Well, the answer is what I just described, which is you can go shopping when everyone else is licking their wounds. So cash has a place. Yeah, and have some equities, have a slice of equities. There's nothing wrong with that. But I run into people and I talk about gold and they go, Jim, how can you sleep at night with that much gold? I said, how can you sleep at night with 90% equities? I mean, that's what would scare me. So that's kind of my view. And again, I would emphasize, there might be a starting place for some allocations, but just be nimble, pay attention. This is not set it and forget it.
That was great, Jim. Two last quick clarifying questions. One, just your thoughts on bonds, particularly as you talk about, interest rates going forward and being in this low growth environment. Um, should we hold fewer bonds than people used to hold in the past, or what do you think?
Well, you can't talk about bonds without distinguishing corporate, municipal, and treasury. So there are three different worlds. Municipal bonds, if it's your locality and they're double, triple tax free, and there's a good credit rating, yeah, that's fine. Corporate bonds I wouldn't touch because they tend to be a lagging indicator. They'll continue to pay high yields and be issued even after the economy has turned, and then they turn after the recession hits. But they'll drop like a stone. That's my expectation. I do like U.S. Treasuries, and the 10-year note yield to maturity right now is about 1.74%, give or take. It bounces around. That's the highest it's been in about 2 years. To go back and look. If you think the bond bull market's over and the bear market's here and the bond market's a bubble, then of course you don't want them. I think the opposite. I think based on what I described about inflation coming down, disinflation prevailing, I would expect that yield maturity in the 10-year note to turn around. And there's a concept called DV01, which is the dollar value of 1 basis point. In other words, in when interest rates come down, bond prices go up. Okay, yields down, prices up. That's basic bond math. But they go up further in percentage terms when interest rates are lower. It's kind of counterintuitive, but at lower levels of interest rates, your capital gain on a given decline in yields is greater. So just a really simple example, if rates go from 9.9% to 8.5% on 10-year notes, you're going to have a gain. If they go from 1.5% to 1% on 10-year notes, you're going to have a gain. Both examples, it went down half a percentage points or 50 basis points, but the gain going from 1.5 to 1 is much greater. The capital gain is much greater than going from 9 to 8.5 as a function of being at lower absolute levels of rates. The bond math is complicated, but that's how it works. So you can get some very nice capital gains on treasuries if yields drop the way I expect.
All right, great. And the last question before we wrap things up. When you were on a panel that I moderated a few months back, you gave a really, I think, important caveat to people about the importance of diversification in a portfolio, and not just the allocation that you just sort of rattled through here, but that most people think they're diversified because they have lots of holdings, but they tend to be still very concentrated in a certain type of risk. So I want to let you give any sort of parting thoughts on the importance of diversification.
Sure. And diversification is a very powerful investment tool. If you do it correctly, you can increase your total yield with less risk. Anybody can get more yield with more risk. That's easy. So say, Adam, give me all your money, I'll manage it for you. And you give me your money and I go to a casino and I put it all in red and I win and I come back and say, hey, I doubled your money. And you're, hey, nice going, Jim. You're a genius. It's like, no, but I could have lost it all just as easily, actually slightly more than 50% chance. So it's easy to get big returns with big risk, and it's usually not a good risk reward. But can you get at least marginally higher returns without more risk? That's the holy grail of investing. The answer is yes, and the tool is diversification. The problem is people don't actually understand what diversification is. And I do run into people, they go, I'm fully diversified. I've got 50 stocks in 10 different sectors. I've got semiconductors, consumer non-durables, transportation, et cetera. I'm fully diversified. And I go, no, you're not. No, you're not. You may have 50 stocks, but you have one asset class. They're called stocks. And they tend to be highly correlated in stressful situations. They go up together in bubbles. They go down together in crashes. In calm markets, yeah, there's some idiosyncratic behavior of stocks, but they tend, it's called conditional correlation. They tend to be highly correlated in a crashing market. So you're actually not diversified at all. All the stocks are going to sink together. Real diversification is got some stocks, got some cash, got some gold, some real estate, some alternatives like natural resources, maybe something in the energy sector. I think I mentioned real estate, some treasury notes. That's real diversification because those asset classes are not highly correlated. Some will go up when the others go down. If stocks are crashing, going into a recession, guess what's happening to interest rates? They're going down. What's happening to your notes? They're rallying and getting big capital gains. And so that's, and many other examples, but that's real diversification. So don't, if you have 50 stocks, good for you, but you're not diversified, you're concentrated in stocks.
All right, great. Well, Jim, thanks so much. Like I said, I wish we had another 2 hours here, but really appreciate you speaking to our audience here at the conference. For folks who want to follow you and learn more about you and your work, where should they go?
I do a lot on Twitter at James G. Rickards. I use my middle initial, but at James G. Rickards. I have a pretty active Twitter feed. And my most recent book is called The New Great Depression, available for portfolio. You can get it at Amazon and good bookstores.
Excellent. Thanks so much, Jim.
Thank you.
I hope you enjoyed this interview with James Rickards as much as I did. And if you'd like to see Wealthion's future interviews with other great minds and money in the markets like Jim, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as the little bell icon right next to it. And be sure to hit the like button too while you're down there. And last, if the sobering market outlook that Jim has detailed in this interview has you feeling a little vulnerable about the prospects for your nest egg, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your portfolio, keeping in mind the trends and strategies that Jim has mentioned here. Just go to wealthion.com and we'll help set one up for you. Thanks so much, and thanks for watching.